You watch the charts rise and fall like tides, predictable in their unpredictability. The green candles stretch toward the sky, validation of your patience, your research, your discipline, until they don't, until red bleeds across your screen and something ancient awakens inside you. Fear. It arrives uninvited, wrapping cold fingers around your throat, making you forget everything you've learned about Bitcoin's long-term trajectory, making you doubt the strategy you built in moments of clarity, the strategy you promised yourself you would follow regardless of market conditions. This is not about technology. This is not about market cycles or institutional adoption. This is about you, your psychology, your relationship with uncertainty. I've watched traders build foundations of knowledge, only to abandon them the moment emotions flood their system, the moment discipline becomes uncomfortable. The pattern repeats with devastating reliability, slowly building, rapidly destroying. A psychological cycle as old as markets themselves. The chaos of crypto markets doesn't create your weakness, it merely reveals it. The volatility doesn't destroy your progress, it simply provides the trigger for your self-sabotage. Your emotions become the assassin of your own potential. The challenge lies not in understanding the market but in understanding yourself. The shadow of impatience that lurks beneath your conscious decisions, the fear that masquerades as rational risk management, the greed that disguises itself as strategic opportunity. This is the shadow work of investing that Jung himself would recognize, confronting the parts of ourselves we'd rather ignore, the parts that sabotage our results despite our best intentions. Are you ready to begin? The discipline of investing exists in direct opposition to your natural instincts. Your biology wasn't designed for markets. It was designed for immediate threats and immediate rewards, not the delayed gratification that creates wealth, not the emotional control required to watch your net worth fluctuate by 20% in a single day without reacting. This is the first paradox you must understand. What feels right in investing is often wrong. What feels wrong is often right. When Bitcoin drops 30% in a week, your instinct screams to protect what remains, to flee from pain, to escape uncertainty. The very same circuitry that once kept your ancestors alive now betrays your financial future. The emotion arrives first, the rational justification follows obediently behind, creating the illusion of reasoned decision-making. I've watched traders create elaborate systems of risk management, only to abandon them precisely when they're most needed. They mistake emotional comfort for strategic thinking. They confuse the release of anxiety with sound judgment. Your relationship with investing mirrors your relationship with life itself. How you respond to market volatility reflects how you navigate uncertainty in all its forms. The impatient trader who cannot stick to a strategy is often the same person who jumps from project to project, relationship to relationship, never allowing the compound interest of consistency to work its magic. The market becomes the perfect mirror, reflecting back your shadow with merciless clarity. Consider the trader who spent months researching fundamentals, who built a thesis around Bitcoin's long-term adoption curve, who understood intellectually that volatility is the price of admission for outsized returns. Yet when the inevitable correction arrived, all that knowledge evaporated in the heat of emotion. Research gave way to reaction. Patience surrendered to panic. This isn't weakness. This is humanity. The gap between knowing and doing, between information and transformation. The routine of discipline only appears valuable in retrospect after results have materialized. In the moment of practice, it feels like pointless restraint, like unnecessary limitation. The mind creates compelling arguments for why this moment is different, why the rules should be suspended just this once. This is not like previous cycles, it whispers. The pattern is broken, the thesis has changed, yet the investors who create generational wealth are those who maintain emotional equilibrium amid chaos, who understand that consistency in process matters more than consistency in outcomes, that the path to mastery requires walking through discomfort rather than around it. The psychological maturity required for successful investing isn't taught in finance courses. It can't be downloaded from a trading tutorial or extracted from a chart pattern. It must be earned through the crucible of experience, through confronting the shadow aspects of yourself that emerge under pressure. Jung would recognize this struggle, the tension between the conscious intention to build wealth and the unconscious patterns that sabotage that very intention, the disowned parts of yourself that emerge precisely when stakes are highest. the emotional complexes that hijack your decision-making in moments of market extremes. This is where your real work begins. The market doesn't reward intelligence. It doesn't reward information. These are merely table stakes. The market rewards psychological alignment, the rare capacity to act in accordance with your own strategy, despite the emotional weather patterns moving through you. What appears to be a financial challenge is, at its core, a spiritual one. The capacity to maintain discipline when every cell in your body cries for relief. The strength to embrace volatility rather than flee from it. To view price movements as data rather than personal commentary on your worth or wisdom. This is where most traders fail, not because they lack information, but because they lack integration. They have not reconciled the competing voices within themselves. The long-term investor battles the short-term speculator. The rational analyst fights against the emotional reactor. The strategic planner conflicts with the tactical opportunist. And in these internal conflicts, capital is destroyed. Notice what happens inside you when Bitcoin drops 20% in a day. The physical sensations, the racing thoughts, the desperate search for certainty in an uncertain environment, the subtle ways your mind begins to rationalize abandoning your strategy, the compelling stories it creates to justify emotional reactions. Perhaps this time really is different. Maybe I should wait for confirmation before buying more. I should reduce risk temporarily until the situation clarifies. These thoughts arrive not as tentative suggestions but as urgent commands dressed in reasonable language. They hijack your prefrontal cortex, the seat of long-term planning, using fear to override your carefully constructed strategy. And here lies the paradox. The strategy you created in moments of clarity is precisely what you're most likely to abandon in moments of chaos. The investment thesis you built through months of research dissolves in minutes of panic. This pattern repeats across time and markets with remarkable consistency. The psychological dynamics that caused traders to sell their Bitcoin at $3,000 after the 2017 crash are identical to those that cause liquidations at every major market bottom. The emotions remain constant, only the price points change. The external appearance of risk obscures the internal reality. What looks like financial risk is more accurately emotional risk. The risk of experiencing temporary discomfort, the risk of feeling wrong, the risk of watching others profit from strategies you abandoned, the risk of confronting your own imperfect nature. Jung would identify this as the tension between the persona and the shadow, between who you believe yourself to be as an investor and the disowned aspects of yourself that emerge under pressure. The rational, disciplined trader identity confronts the impulsive, fearful aspects previously denied. True investing discipline is not the absence of fear, but the capacity to act with precision despite its presence, to feel the full intensity of market uncertainty without allowing it to dictate your decisions, to create space between stimulus and response, between price action and your reaction to it. This capacity is not developed through more information or better indicators. It emerges through psychological practice, through deliberately exposing yourself to the discomfort of uncertainty in progressively larger doses, through maintaining position sizes that allow you to function at your best rather than your worst, through tracking your emotional states as methodically as you track your trades. Consider implementing a psychological circuit breaker in moments of market extremes. When emotions reach fever pitch, whether euphoria or terror, commit to a mandatory waiting period before making decisions, 24 hours of reflection before selling during crashes, 24 hours before buying during parabolic advances. This creates the distance necessary for your prefrontal cortex to regain control from the limbic system. The most powerful question you can ask in moments of market intensity is simply, what would my best self do in this situation? Not your fearful self, not your greedy self, but the version of you that maintains fidelity to your own strategy, the version that respects the research you conducted and the principles you established. Most traders succumb to what psychologists call temporal discounting, the tendency to value immediate emotional relief over long-term financial gains. The pain of watching unrealized profits evaporate becomes so acute that they accept the permanent loss of selling at a bottom to escape the temporary discomfort of sitting through a drawdown. Your relationship with time determines your relationship with markets. The investor who thinks in decades has an insurmountable advantage over one who thinks in days. The capacity to maintain emotional equilibrium through market cycles correlates directly with your investment time horizon. When you trade frequently, each price movement becomes a referendum on your identity. When you invest strategically, price movements become opportunities rather than threats. Routine creates the foundation for this psychological resilience. Not the exciting routines that traders seek, but the boring, consistent practices that seem insignificant in isolation yet compound over time. The daily review of your investment thesis rather than the price, the regular audit of your emotional state, the consistent position sizing that ensures no single outcome can destroy your capital or confidence. The paradox deepens. The more attention you give to process, the less you need to give to outcomes. The more you focus on maintaining discipline, the less you need to worry about results. The system produces what the system is designed to produce. Your job is not to force outcomes, but to maintain the integrity of your approach through market cycles. This isn't merely about financial returns. It's about who you become through the practice of investing. The capacity for emotional regulation transfers to every domain of life. The ability to maintain clarity amid uncertainty becomes a meta skill that transcends markets. Bitcoin's volatility offers the perfect training ground for this development. Its dramatic price swings compress psychological lessons that might take decades to learn in traditional markets into cycles of months or years. Each correction becomes an opportunity to practice emotional non-reactivity. Each rally tests your capacity to maintain strategy rather than chase euphoria. The investor who masters these psychological dynamics doesn't just survive market cycles, they harness them. They recognize that volatility creates opportunity precisely because most market participants respond emotionally rather than strategically. They understand that the pain of sitting through drawdowns is the very mechanism that creates outsized returns, the risk premium paid to those with psychological fortitude rather than merely financial capital. This understanding doesn't eliminate the challenge. The fear never fully disappears, the impulse to abandon strategy never completely subsides, but with practice, these emotions transform from overwhelming forces into familiar weather patterns passing through your awareness. You learn to observe them without being controlled by them, to feel fear without becoming fear. And in this space of awareness, between stimulus and response, lies your power as an investor, your capacity to choose rather than react, to align your actions with your strategy rather than your momentary emotional state. The long-term success of your investing journey will be determined less by the specific assets you select and more by your relationship with uncertainty itself, by your capacity to maintain discipline when discipline feels most uncomfortable, by your ability to act from your highest intelligence rather than your most pressing emotion. This is not merely investment advice. This is a path of personal development disguised as financial strategy, a journey toward integration rather than merely accumulation, toward becoming the kind of person who can create wealth because you're no longer driven by the psychological patterns that destroy it. The journey toward investment mastery is not linear. There will be moments of profound clarity followed by humbling regression, periods where discipline feels effortless and periods where it requires everything you have. This cycle of integration and disintegration is not a failure of progress but the very mechanism through which psychological growth occurs. Jung called this process individuation, the gradual integration of the unconscious with the conscious self. In market terms, it's the slow reconciliation between your strategic intentions and your emotional reactions, between the investor you aspire to be and the human you currently are. The question is not whether you'll experience fear during Bitcoin's dramatic corrections or greed during its parabolic advances. You will. These emotional currents move through all investors regardless of experience. The question is whether you've developed the capacity to create space between these emotions and your actions, whether you can feel the full intensity of market uncertainty without being defined by it. This capacity doesn't develop through avoidance but through deliberate practice, through consciously staying in positions when every instinct demands escape, through maintaining your buying schedule when prices are falling rather than rising, through the steady accumulation during periods of maximum pessimism, when consistency feels most pointless. The results you seek emerge from this practice, though rarely in the time frame you expect. The market moves according to its own rhythm, not your desires. Your only control lies in the quality of your decisions, not their outcomes. In the maintenance of discipline when discipline feels most challenging, return to this truth when market narratives grow loudest, when new paradigms are proclaimed and old wisdom dismissed, when greed or fear reach extremes that make rational analysis nearly impossible. Remember that what feels urgent in markets is rarely important, and what's important rarely feels urgent. The long-term investor finds peace not in the absence of volatility but in their relationship with it. In the understanding that market cycles are neither punishment nor reward, but the natural rhythm of human psychology expressed through price, that these cycles create the very opportunities they're designed to exploit, precisely because most participants cannot maintain emotional equilibrium through extremes. Your task is not to eliminate the internal conflict between fear and strategy, between short-term comfort and long-term growth. Your task is to develop the capacity to hold this tension consciously, to feel the pull of emotional reaction without surrendering to it, to recognize your psychological patterns without being governed by them. In this awareness lies freedom, the freedom to choose your response rather than be driven by it, the freedom to align your actions with your strategy rather than your momentary emotional state, the freedom to participate in markets without being psychologically possessed by them. This is the discipline that creates consistent results across time. Not the rigid discipline of perfectionism, but the flexible discipline of conscious choice. The capacity to bend without breaking, to adapt strategy when warranted while maintaining psychological stability through extremes. The investor who masters this inner game doesn't just accumulate assets, they develop a relationship with uncertainty that transfers to every domain of life, a capacity for emotional regulation that becomes its own reward, independent of market outcomes. This is the paradox at the heart of successful investing. The less attached you become to results, the more likely you are to achieve them. The less reactive you are to short-term price movements, the more you can harness long-term trends. The more you focus on maintaining disciplined process, the less you need to worry about unpredictable outcomes. The market reveals who you already are. It offers the opportunity to become who you might be. The choice, as always, remains yours.